Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. Since last week, we had a CPI print that was hotter than expected, specifically core inflation, which was excluding food and energy, being the highest since 1982. So again, the question becomes, what is the Fed going to do? What do we expect the Fed to do? I don't think many people at this point, as much as they want, expect a pivot from the Fed necessarily. Things do not look broken enough, but the ultimate fundamental question is, how much do they have to raise in order to actually tame inflation? If that's even possible, which is a crazy notion to think about for some people. But again, if this is supply versus demand and more of a supply issue than a demand issue, then crushing demand won't necessarily crush inflation. Time will tell. We will see. We're living it in real time. The current market expectations are 275 basis point hikes, the next being in November 2nd. And timing of all this is important because volatility in crypto land has just plummeted rather fast. I'll talk about that in a second. But we've got the Fed meeting on the 2nd. We've got U.S. Midterm elections on the 8th. So the 2nd is Fed meeting, the 8th is midterms. And one or either of those events may have a significant impact on the market, especially when we are basically flat on crypto side of things, on digital assets. And we've had some interesting headlines over the past week, really. Now, this is the 10th, specifically mentioning Bollinger Bands here, which I'll talk about. And one thing that's always good to know and to bring out when things get extremely unexciting, for the lack of a better word, when volatility crunch is occurring, Bollinger Bands are the single best indicator on price, as far as I'm concerned. And we've had additional headlines about a lack of volatility being a warning flag. It's interesting when you're known for volatility that not having it seems to be problematic for people. Another article talking about what crypto traders are doing. And I'm thinking to myself, this is the exact time to plan out a trade plan, a long-term, short-term, whatever it is surrounding this volatility, especially if it's an extended price squeeze. And then Cumberland coming in and saying, yes, volume matters more than volatility. And that's fair as well. But we've become so non-volatile relative to other assets. This is the Dow Jones relative to BTC. BTC becoming less volatile than even the Dow Jones. And if we look at this 30-day rolling volatility in the green here against price, we see some interesting things relative to what's happening now. So if we assign this a value 0.0197, 30-day rolling volatility, similar to pre-October breakout, similar to July 2020, similar to October 2018. So the expectation here is definitely be prepared for a large move, a large reaction as things are coiling here. Another way to look at this is how much can we squeeze or how long can we squeeze on volatility. And the mega squeezes certainly have lasted 6.6 weeks on average. And we could be due for some continued contraction. You know, this could take us all the way to November 2nd, or November 8th into November, where we just basically flatline, sort of waiting for a catalyst. And we are still relatively correlated to the S&P, even though historically we have not been. That's the 60-day, 30-day, starting to fall off, 180-day. You know, depending on the time frame you want to look at this, we are still screaming high on correlations. And on the inverse side of things, against the dollar, we are still highly negatively correlated, although that's coming off slightly. So I think the Fed attitude is going to be important as we're still relatively correlated, right? The market's waiting for something. That something is probably going to be the Fed in a couple weeks, even though the expectation, again, is a 75 basis point hike. I haven't seen too much chatter about 100 basis point hike, but I'm kind of surprised that the 100 basis point hike is at zero expectation right now. That may change if somebody leaks a number, but I expect the market to be highly sensitive to all of that activity. And if we look at the DXY specifically, also looking weaker, still at multi-year highs, right? This goes back to 2015. This is the weekly. You have this parabolic upside, more or less related to fundamental reasons with everything going on in Europe, dollar milkshake theory, potential sovereign debt crisis, a bunch of issues going on that are fueling this. But as I've been saying for the past couple of weeks, based on technicals alone, if I was on a deserted island, it was like me, a coconut, and the ocean, then the expectation here is the DXY should continue to relax. And if we look at lower time frames, we're setting up for a potential inverted Adam and Eve, M double top type of fractal, a V and a U. If this actually plays out, it would be rather textbook. Now, as a trade setup, this is definitely a breakout trade where you're waiting for the pattern to complete. But as it's happening, you can say, well, we know what this fractal might look like. We know where this goes. And especially if you're seeing this at the top of a market, you're starting to stack up a narrative here for a bias one way or the other. So as bearish as everything does look, the DXY also looks like it might continue to roll over here. And another reason why volatility is so low on BTC is because there isn't much activity on chain. There's not a lot of coin movements in general. This is the percent of the supply that it's been last active over the past year. And you can see it's basically an all-time high as far as coins that haven't moved in quite some time. So we're also coiling on the holder metric, if you will. We haven't seen panic yet. We haven't seen people send a bunch of coins to exchanges. That typically happens after a move down, if we do get a move down. But if we do slip lower, unlocking this coin supply does help price move lower, if that makes sense. Looking at technicals here, not much has changed week over week, really over the past 3 weeks. If we look at all the things that I'm highlighting here on the chart, MAs, Ichimoku Cloud, Pitchfork, previous all-time high, nothing here is screaming long to me. Nothing here is screaming short necessarily either, but the bias certainly is bearish. We are below litmus tests we need to be above in order to be bullish. And it's really just that simple. It's black and white. The trend is your friend until the end. And the bigger issue here is really when it comes down to the weekly Bollinger Bands, which I'll get to in a second. And realistically, we could retrace the entirety of the 2021 rally. It's certainly not something I want to happen, but realistically, when we're talking about these volatility squeezes, unless something dramatic happens here between now and probably the beginning of November, there's a decent probability for significant downside. And if anything, I'm most confident right now in being long volatility rather than short, or rather than having a straddle or a strangler or some sort of other trade setup here. As volatility contracts, you're going to see more and more people looking to long volatility. So this to me is the worst case scenario would be 10 to 13K, potentially by the end of the year, potentially throughout 2023, but even by the end of the year would be reasonable based on the pitchfork here. And here's really the heat of the meat. The biggest problem with being bullish right now is when we look at Bollinger Bands, when we zoom way out, another way of measuring volatility, when we look at Bollinger Band width here, Bollinger Bands measure 2 standard deviations above and below the 20-week moving average. So long as price remains below the 20-week moving average, there's a bearish expectation, there's a bearish bias here. If volatility contracts while price remains below that 20-week moving average, the expectation is a breakout to the downside. So that's currently what we're setting up for here. A similar setup that we had earlier this year, I believe it was in April, and you can go back and watch even the videos on this channel, the documentation weekly review that we put out leading up to that point where I was saying the exact same thing, that look, we are bearish, have been bearish below the 20-week moving average here. And the important part about this analysis is the rationale is the same, whether it's 2013, 2015, 2018. So long as we're below that moving average, the expectation is lower. And you can see how previous squeezes of this caliber have resulted in quite large moves, both up and down. So I think we've got 4 weeks probably max on this, which does bring us into the beginning of November. And again, zooming in just a little bit, you can see even since the most recent halving, this is the second squeeze of this caliber that we've had. And as we sit here today, we're below the 20 moving average. And just like 2018, the more weeks you close below consecutively as volatility is contracting, that expectation, that probability, that bias just grows and grows and grows. And then it really is no surprise when price does move to the downside like that. ETH very much the same. It's below levels you'd want it to be above for a bullish trend. It's still within the downward facing pitchfork. And ETH is slightly different in that it's not sort of cliffing on lows. It's got levels lower to consider, 1,000, 800, something like that. But Bitcoin won't act alone in moving lower if it does that. On Bollinger Bands, ETH as well is historically tightening. This will look more convincing in 1 or 2 weeks. But if we zoom all the way out since 2016, we don't get these squeezes in volatility too often. We've had a bunch this year, but historically we don't get this on ETH. And again, it's below that 20-week moving average. Really, it's been below the 20-week moving average fairly consistently since January. And really what you want to see is continuation above the 20-week if you're bullish. And using logarithmic regression for ETH, 750 is a decent level in the near term. Near term for me is the next, basically to the end of the year, if we see this squeeze sort of play out. Now, if the Fed does pivot, which I certainly don't expect happening, then you probably see a move to the upside. But as we sit here today, we're set up across the board for pushing lower lows. And even if we measure this out using Fibonacci extensions and we say, okay, on ETH, the last sort of fractal maybe was a head and shoulders, maybe it was some sort of reversal pattern. We're currently at a consolidation level, and the next level down would be 1050 to 800. That's reasonable within those June, July lows. And the last thing I really want to touch real quick is the stablecoins. USDC continues to fall off here. USDC, maybe the purest signal of United States inflows or inflows from the United States. Tether's more global, Binance USD more global, DAI semi-related to USDC. So there's a decent argument to be made here that so long as USDC continues to decline, again, that expectation is flows are muted, flows are low, flows are flat, and there isn't a lot of activity looking to come into the market here. Alternatively, you could also say, if we look at stablecoin dominance, which is the market cap of stablecoins relative to the entirety of all digital assets, you could say, well, look, there's still quite a bit of dry powder by this metric. Really, this is at an all-time high at around 16%. There's a lot of dry powder sitting out there, whether it be in DeFi, whether it be on exchanges, wherever it is, looking to buy something, right? Looking to buy lows. Maybe it's sitting in yield, but as muted as flows may have been in recent weeks, we're not seeing a massive vacuum across the board for stablecoins being removed from the ecosystem. So that's all for this one this week. Let me know what you think in the comments below, and happy trading.